Welcome to new video. Today we will learn about the power of risk management in Forex and crypto trading. Let's begin. Why this is important. Many beginner traders focus on making profits and overlook the importance of risk management. This video will teach viewers how to protect their capital and maximize their trading longevity. It's a critical concept that even some experienced traders neglect until they face losses. What is risk management? So, let's start with the basics. Risk management in trading is all about controlling your potential losses. It's about making sure that no single trade can completely wreck your account balance. Think of it like this: trading without a solid risk management plan is like gambling. You're essentially leaving your success up to luck. But when you manage your risk, you're in control. At its core, risk management involves understanding how much of your total capital you're willing to lose on each trade. By defining these boundaries in advance, you're making sure that one bad trade won't cause you to lose everything. If you're consistent and disciplined with your risk management strategies, you'll be able to weather the inevitable losses and come out on top in the long run.
Key risk management strategies. Position sizing. Let's talk about position sizing. This is one of the most important aspects of risk management. Position sizing refers to how much of your total account you're willing to risk on a single trade. A general rule is to risk only 1 to 2% of your account balance on each trade. For example, let's say you have a $1,000 account, and you're comfortable risking 1% per trade. That means you're risking $10 per trade. If your stop loss is 50 pips away, you can calculate the size of your position accordingly to ensure that if you hit your stop loss, you lose no more than $10. Let me walk you through how you calculate it. Risk amount equals account balance x risk percentage, 1% or 2%. Stop loss distance equals distance from entry price to stop loss, in pips or price. Position size equals risk amount, stop loss distance. Stop loss orders. Next, let's talk about stop loss orders. A stop loss is a tool you use to automatically close your trade if the market moves against you by a certain amount. It's essentially your safety net. Without a stop loss, you're opening yourself up to huge, unexpected losses. Imagine a scenario where the market suddenly moves against you, and you're not monitoring your trade. Without a stop loss, that trade could spiral out of control. Here's an example. If you enter a trade at $50 and set a stop loss at $48, your trade will automatically close if the price hits $48, locking in your loss and protecting the rest of your account. Risk to reward ratio. Let's now talk about the risk to reward ratio. This is the relationship between the potential loss and potential profit on a trade. A common recommendation is to aim for a risk to reward ratio of at least 1:2. Calculating the risk-to-reward ratio for each trade is one of the easiest ways to determine if a trade is worth taking. Psychological factors in risk management. Risk management isn't just about math and tools, it's also about controlling your emotions. Greed and fear are the two biggest emotions that affect a trader's ability to manage risk. When you're feeling greedy, you might over-leverage or take trades that aren't in your plan, just to chase bigger profits. On the other hand, fear might cause you to exit a trade too early or avoid trades altogether, missing profitable opportunities.